Ever tried organizing a huge group dinner? If one person pays, it's a massive financial risk. But if everyone chips in, you suddenly have a huge budget to buy a feast without ruining anyone's bank account. That is the genius of a financial fund. You pool your money with other investors to buy a massive, stable slice of the market, rather than risking everything on one unpredictable stock. But once you have that massive pool of cash, a critical question emerges. Who actually gets to decide which companies you buy? For decades, the standard answer was the mutual fund. You hand that pooled money over to a team of highly paid professional managers. Their entire job is to actively analyze the market, pick the best assets, and try to beat the average return. These vehicles were popularized and managed by some of the most historic institutions on Wall Street. As an investor, you were paying for access to elite financial minds and a sophisticated legacy. This chart shows the active system's hidden friction. Managers take an annual fee, up to 1.5%, straight from the top, even if you lose money. Furthermore, long-term graphs prove most actively managed funds consistently fail to outperform the basic market benchmark. If highly paid Wall Street experts cannot consistently win over the long haul and may still charge you steep tolls for trying, then the everyday investor doesn't need a better expert. They need a mathematically superior system. That mathematical correction is the index fund. Instead of paying a human manager to guess which stocks will win, an index fund uses a radical logic. It passively buys the entire scoreboard. It simply copies a list representing a certain part of the market, like the S&P 500, which automatically holds 500 of the biggest companies in the United States. Different indexes track different sectors of the economy. While some follow modern tech giants, others, like the Dow Jones Industrial Average, focus on massive, established companies across traditional industries. This allows you to own a tiny piece of 30 major American corporations all at once. By removing the human manager from the equation, the cost to the investor drops exponentially. Instead of paying over 1% in fees, most index funds charge an expense ratio as low as 0.02%. You're paying literal pennies for a computerized system. This low-effort, low-cost approach is so historically successful that elite investors actively champion it. Even Warren Buffett recommends that the average person simply buy an index fund and hold on to it over the long term. There is a specific catch to this passive approach, though. Index funds operate on a delayed system. You cannot treat them in real time during the day. Buy and sell orders only process at a single fixed price, calculated after the stock market closes at 4 p.m. By solving the high fees and the human error of mutual funds, index funds strip away the friction of investing. But in exchange for that stability, they force you to completely sacrifice real-time trading control. But what if passive safety and delayed trading don't appeal to you? What if an investor demands aggressive control and outsized returns? That leads us to the extreme, divergent branch of the financial world, the hedge fund. Managers here use dangerous mechanics to chase massive profits, employing aggressive tactics like short selling, betting against a stock, and leverage, which means borrowing money to multiply their investments. To run these complex operations, they charge brutal fees. Hedge funds are notorious for the 2-in-20 model, a strict 2% annual management fee, plus 20% of any profits the fund actually makes. Because the volatility is so high, these funds are legally locked behind velvet ropes. They are open almost exclusively to accredited investors, individuals or institutions with incredibly high net worth or massive incomes. Hedge funds are the total opposite of the everyday index fund. They function as a high-risk casino built exclusively for the ultra-rich, offering zero utility to the average person looking to safely grow their savings. So the everyday investor faces a strict mechanical dilemma. Mutual funds are too expensive, index funds are rigidly locked to end-of-day trading, and hedge funds are completely off-limits. The answer to that problem is the modern synthesis of investing, the ETF, or exchange-traded fund. This diagram shows how ETFs act like a technological bridge. They adopt the same broad, low-fee diversification as an index fund, packing hundreds of stocks together. But their true mechanical advantage is flexibility, allowing you to trade continuously in real time throughout the day. When you contrast the seamless, instantaneous digital trading of an ETF today With the historic chaos and physical friction of traditional stock exchange floors, you see exactly how efficient the market has become. Modern brokerage platforms have made ETFs perfectly accessible. Anyone with a smartphone can now buy into the S&P 500 or the Nasdaq, often executing those real-time trades with zero commission fees. The modern investor is no longer trapped by high-fee managers or exclusive wealth clubs. By combining the low costs of an index fund with the real-time flexibility of a stock, ETFs provide anyone with the exact mechanical blueprint required to build long-term, lasting wealth.